At the beginning of the 20th century, the United States had no central bank. This was not an oversight, it was a deliberate outcome. Earlier attempts at centralized banking had collapsed under political pressure. They were widely viewed as instruments of concentrated financial power, so the country chose fragmentation instead. Thousands of banks operated independently. Reserves were local, coordination was informal. Clearinghouses existed, but authority was limited. Trust was personal, not structural. For decades, this arrangement appeared to function. Industrial output expanded. Railroads stretched across the continent. Capital flowed, but the system rested on confidence. And confidence is uneven. By 1907, strain was visible. Interest rates were high. Credit was tight. Speculation had spread through mining, railroads, and commodities. Much of this activity relied on leverage. Leverage works until timing turns against it. The trigger came quietly. A failed attempt to corner the copper market collapsed. Several institutions connected to the speculation began to falter. The details mattered to insiders. To the public, the signal mattered more. A major institution looked unstable, and there was no safety net. No federal lender of last resort, no deposit insurance. When doubt appeared, depositors did what the system trained them to do. They withdrew. Bank runs did not begin everywhere. They began where reserves were thin. At trust companies, these institutions promised higher returns. They held less cash. When one failed, others were questioned, then avoided, then emptied. Within days, liquidity vanished from New York. This is important. Most banks were not insolvent. Their assets still existed, but assets could not be converted to cash fast enough. The problem was not value, it was timing. Individual banks could not solve this alone. Each institution saw only its own balance sheet, but fear crossed boundaries. What the system required was coordination. Clearinghouses attempted to respond. They pooled information. They evaluated member banks. They issued emergency loan certificates. These certificates functioned as temporary money between institutions, but not for the public. Depositors wanted cash, not reassurances. As withdrawals continued, private coordination became unavoidable. This is where J.P. Morgan became central, not as a planner, not as a mastermind, but as a focal point. Morgan sat at the crossroads of the financial system. He was connected to major banks, trust companies, and industrial firms. More importantly, he was trusted by other financiers. In a crisis, trust becomes leverage. Morgan convened emergency meetings. Bankers were summoned to his library. Negotiations extended late into the night. Institutions were assessed quickly. Some were supported. Others were allowed to fail. This distinction matters. Support was not universal. Resources were finite. Choices had consequences. What mattered most was speed. Decisions were made faster than any public authority could respond. Not because government was unwilling, but because no framework existed. One episode made the situation unmistakable. A large trust company faced collapse. Its failure threatened to trigger a wider panic. Morgan hesitated. Only when other bankers agreed to share the risk did intervention proceed. This moment revealed something fundamental. Stability depended on cooperation. Cooperation depended on alignment. And alignment depended on influence. The panic gradually eased. Markets reopened. Withdrawals slowed. Confidence returned, unevenly. But the experience left something behind. Not fear, memory. Bankers remembered how close the system came to failure. They also remembered what worked. Informal coordination, centralized judgment, rapid decision-making, but this structure existed nowhere on paper. It relied on personalities, on reputations, on private authority that made it efficient and fragile. J.P. Morgan was not a public institution. He had no mandate, no accountability, and no guaranteed successor with comparable influence. This raised an uncomfortable question. What happens next time? The panic of 1907 did not invent the idea of reform, but it narrowed the options. A financial system of this scale could not rely indefinitely on improvised private intervention, not because it was immoral, but because it was unstable. What the panic demonstrated was not the danger of finance itself, it was the danger of improvisation during systemic stress. The outcome was not a decision, it was a realization. If coordination was inevitable, it would eventually be formalized. The question was no longer whether, the question became how, and who would sit at the center next time.